Most investors are walking straight into a trap. They see a 10% yield, they get excited, and they dump their life savings into a company that's actually dying. It's called a yield trap, and it's the fastest way to stay poor while feeling like you're winning. If you want to build a portfolio that actually pays for your lifestyle, you need a structural system. Today, I'm revealing the three-pillar framework. This is the core strategy I use to ensure growth, stability, and cash flow, no matter what the market does. And pay attention to pillar number 3. It's the secret to early retirement that most people get completely wrong. So make sure to stay until the end, so you don't miss that final piece of the puzzle, and subscribe to the channel to join our journey toward financial freedom. Let's dive in. Before we dive into the numbers, a quick reminder. I am not a financial advisor. This video is for educational purposes only. Investing involves risk, so always do your own research before putting your money to work. Now, let's build those pillars. Let's break down the system, starting with pillar number 1, the engine. This is the growth component. Without an engine, your portfolio will eventually be eaten alive by inflation. You need assets that capture the total return of the market. A perfect example of an engine is VOO, the Vanguard S&P 500 ETF. It tracks the S&P 500, giving you exposure to the 500 largest U.S. companies like Microsoft, Apple, and Amazon. Over the last decade, this strategy has delivered an average annual return of over 12%. With an expense ratio of just 0.03%, you're capturing nearly all of that growth for yourself. It's a low-cost powerhouse that ensures your wealth keeps expanding. But growth has a dark side: volatility. In a moment, I'll show you the specific asset I use to protect my capital when the market starts to bleed. Now, growth can be volatile, and that leads us to pillar number 2, the anchor. This is the quality control of your portfolio. The goal here is stability and consistent raises. My gold standard for an anchor is SCHD. It doesn't just look at yield. It uses a strict algorithm to filter for the 100 strongest companies. Every year, it automatically rebalances, kicking out the laggards and doubling down on those with the best balance sheets. This ensures your portfolio stays high quality without you having to lift a finger. Over the last 10 years, this approach has delivered a dividend growth rate of about 11% annually. With an expense ratio of just 0.06% and a current yield around 3.4%, this pillar protects your capital and grows your income even when the market is bleeding. However, even with growth and stability, there's one thing missing: immediate cash flow. Stick around because the third pillar is the literal ATM that pays for my life today. Now you're safe and growing, but how do you get paid right now? That brings us to pillar number 3, the gas. While the first 2 pillars build your future, the gas pays for your life today. This is where we maximize immediate cash flow. A popular tool for this is JEPI, JP Morgan Equity Premium Income ETF. It generates monthly income by using an active covered call strategy, which results in a massive yield, often between 7% and 10%. Because this is an actively managed fund, the expense ratio is higher at 0.35%, but that is the price you pay for professional management and immediate liquidity. Think of this pillar as the literal ATM of your strategy. It provides the liquid cash you can use to pay bills, or even better, reinvest back into your engine and anchor to accelerate the entire snowball. Stick around, because next, I'll show you exactly how to split your money between these 3 to find your perfect balance. So, how do you actually build this? For most investors, a balanced approach is key. A common starting point is a 50-30-20 split. You put 50% into your engine, VOO, to capture long-term market growth. You allocate 30% to your anchor, SCHD, to ensure stability and dividend raises. And finally, you put 20% into the gas, JEPI, to fuel your immediate cash flow. But here's the beauty of the three-pillar system. It's modular. If you're young and want maximum wealth, you tilt more towards the engine. If you're nearing retirement and need to pay the bills, you turn up the gas. You are the architect of your own financial freedom. Stick around for one final tip on how to automate this whole process so it runs on autopilot. As promised, here is the final tip to making this work. Automate it. Don't rely on your willpower to invest every month. Most brokers today allow you to set up a recurring buy. By automating your 50-30-20 split, you remove emotion from the equation. You'll be buying more shares when the market is down and staying consistent when it's up, all while you sleep. This three-pillar system is your blueprint for building a life where your money works harder than you do. But how does this actually scale over time? In my next video, I'm going to show you the exact math. We'll look at how this targeted approach can lead to early retirement or a life-changing fortune, depending on where you are in life right now. Hit the like button and subscribe so you don't miss that breakdown. I'll see you in the next one.